Ladies and gentlemen, welcome back to Vietnam Stock Market Opportunities. It's an honor to be with you today. And if you want to open a legal trading account, please contact us through the email Vietnamstockmarket.entry@gmail.com, Telegram Vietnamstockmarket.entry, with the phone number is 8491-432-6556. Or you can also scan the two QR codes on the screen so that we can support you. And the other way to contact with us is please follow and subscribe the channel name Areca Capital's channel. The owner of this YouTube channel is Areca Hồng Nguyen. She's a personal financial advisor and a Viet Capital Securities stockbroker manager. You can contact her with the email home.nguyen@vcsc.com.vn with the phone number is 8491-432-6556. We always welcome you to our office on the 11th floor, 109 Trường Đạo Street, Hoàn Kiếm District, Hà Nội, Vietnam. And today I'm gonna share with you about Vietnam Strategy 2023. Let's continue to the bank's uncertainties remain, but valuations are attractive. Consumer finance recap and outlook. Consumer loans grew faster than system-wide credit in 2010 to 2020. According to PE Credit and the SBV, the CAGR of consumer loans was 33.7% compared to 17.3% for system-wide credit in 2010 to 2020. According to the SBV, as of the 30 September 2022, outstanding consumer loans amounted to 2,420 trillion Vietnam dong, more than 16% compared to 2021, accounting for nearly 21% of the system-wide credit balance of the economy, with 84 credit institutions participating in lending activities, including banks and consumer finance companies. Meanwhile, outstanding consumer loans of consumer finance companies amounted to 145 trillion Vietnam dong, more than 21% compared to 2021, accounting for nearly 8% of the system-wide consumer loan balance and 1.3% system-wide credit balance. Despite short-term volatility, we believe the potential growth of the consumer finance segment is high in the long term. According to a report on labor and employment by the General Statistics Office of Vietnam, the employed population 15 years old and above in Q3 2022 was 50.8 million, more than 50% of the population, and the rate of informal employment in Q3 2022 was 54.1%. Vietnam is still a lower middle income country. It has a population of around 99.3 million. Moreover, according to PEC, consumer loans to Vietnam's GDP in 2019 was 28%, which was low in comparison with Thailand, 38%, Malaysia, 57%, and other developed Asian countries like South Korea and Japan, nearly 60%. We estimate that consumer loans to GDP as of 2021 was 25%. We believe the potential for growth of consumer finance in Vietnam is high as there is still talent. Latent demand from low and middle income individuals who have more difficulties in approaching bank loans. Growth at PEC was slow to recover, whereas HD Ceylon rebounded quickly from a low base. According to our estimation, as of Q3 2022, PEC remained the biggest player in Vietnam's consumer finance sector. In terms of lending book, assets had market share of around 50%. PEC's loan balance increased 3.4% in 9 months 2022 compared to 9 months 2022 loan growth of 26.2%. That HDS, we forecast 8% loan growth for PEC in 2022 forward, whereas HDS will finish 2022 forward with 27% loan growth. We expect one, the interest rate hikes in 2022 forwards, and two, economic challenges in 2023 forwards will put pressure on credit demand for consumer loans as low and middle income individuals account for a vast majority of the consumer finance consumer base. However, in October 2022, FEC and HDS signed an agreement with the Vietnam General Confederation of Labor to deploy a support package of 20 trillion Vietnam dong for industrial park workers across the country. Accordingly, each company will provide loans worth 10 trillion Vietnam dong in total, with a preferential rate at 50% of the normal interest rate offered to ordinary customers. From our discussion with the companies, we understand that the support package is derived from the state budget and therefore will not impact the company's earnings. Moreover, while there could be difficulties that could hinder the consumer loan growth, we believe FEC and HDS have advantages in expanding their loan book in 2023 forward because they are one, the big players in the market with strong reputations, and two, have been chosen to distribute the government's support package. We forecast 2023 forward loan growth of FEC had and HDS at 10% and 20% respectively. Consumer finance segment net interest margin likely to be more negatively affected in the short term by recent interest rate hikes. In 9 months 2022, the net interest margin of FEC and HDS gradually improved from a low base in Q4 2021 that was caused by the negative impact of COVID-19. However, we believe the net interest margin of consumer finance companies will be negatively affected in the next few quarters following the recent interest rate hikes due to one, a time lag in adjusting lending rates as consumer finance loans are mostly short-term with fixed lending rates, and two, higher visuals of accrued interest that could be triggered by a potential deterioration in credit quality resulting from an unfavorable economic outlook in 2023 forwards, as well as higher interest rates. HDS management estimates that its net interest margin will fall around 2 ppts to approximately 28% in the next or 2 or 3 quarters, and then quick up in Q2 to Q3 2023. Asset quality to be under pressure in 2023 forwards. PEC's NPL ratio surged 4 PPTs year-over-year as of Q3 2022, which we attribute to its slower write-off strategy as FEC's annualized write-off rate in 9 months 2022 of 11.6% was lower than 16.7% in 9 months 2021. Meanwhile, HDS NPL ratio was relatively flat year-over-year due to its strong loan growth in 9 months 2022. Following our expectation that the repayment ability of consumer finance company customers will be negatively impacted by unfavorable economic conditions, we conservatively forecast the 2023 forward NPL ratios rose up for write-offs at FEC and HDS will increase 8.4 PPTs and 4.1 PPTs compared to Q3 2022 to 26.7% and 23% respectively. Figure 173 NPL ratios and cumulative write-offs to gross loans of FEC and HDS Q1 2020 to 2023 forward. And now let's move on to the next part. Themes for the banking sector. Solutions for distressed credit institutions. The rescue of distressed credit institutions was one of the highlights of 2022. In our interpretation, the main idea of this program is for healthy banks with advantages granted by the SBV to support weak credit institutions in generating earnings to absorb their accumulated losses. At their AGMs held in early 2022, 4 banks in our coverage universe sought shareholders' approval to participate in the support of distressed credit institutions. VCB, MBB, VPB, and HDB. While VPB's disclosure regarding the program was limited, VCB, MBB, and HDB's disclosures had more details, with VCB's disclosure being the most detailed. We believe that VCB will support CB Bank, MBB will support Ocean Bank, VPB will support GP Bank, and HDB will support Dong'a Bank. On the 14th October 2022, the SBB announced that it was putting Saigon Commercial Bank under special control. According to the SBB's press release, special control of a credit institution is a formal measure to 1. Ensure normal operation and liquidity of the bank, as well as 2. To strictly limit the negative impact on the banking system. As the size of SCB is rather large, it was the 5th largest bank in Vietnam by total assets as of Q3 2022. We believe it is difficult to expect a similar rescue program for SCB as per the case of the zero-dome banks, and Dong'a Bank. Perhaps support from more than one healthy bank may be required. Implication of support scheme. Based on VCB's proposal for the rehabilitation of a zero-dome bank, the most detailed plan so far available, we see the following implications. VCB mobilize low-cost funding from the deposit insurance of Vietnam through bond issuance to the DIV. VCB then looks out for good loans and disperses loans using low-cost funding sourced from the DIV. VCB then sells these good loans to the DCI. We use quotation marks because it is unclear at this stage whether VCB is allowed to charge a profit margin on what is originates. But what is clear is that VCB is allowed to pass on all costs incurred. The DCI receives good loans dispersed by VCB to supplement the loans originated by itself using low-cost funding sources from the government. The DCI could earn relatively high net interest margin with high-quality loans under this scheme. In addition, loans received from VCB are not subject to general provision, which supports the DCI's earnings to absorb accumulated losses. VCB pays the coupon on bonds issued to the DIV using payment received from the DCI. We summarize our implications of this support scheme in Figure 175. State Bank of Vietnam. SBB offers loans to the DCI with interest rates as low as 0%, low cost funding for the DCI. There are several differences in the bank's proposals to support DCIs. HDB can inject capital on the acquisition day at a maximum amount of 9 trillion Vietnam dong with scope for later capital contributions as agreed with SBV. Meanwhile, VCB did not mention about injecting additional capital, and MBB proposed maximum capital contribution of 5 trillion Vietnam dong, but gave no specific timeline. However, we believe the core mechanism is somewhat similar between banks, in which the acquirers with advantages granted by the SBB, higher credit quotas and lower funding costs support quick credit institutions in generating earnings to absorb their accumulated losses. Please see further discussion regarding MBB and HDB's proposals to support DCIs in our update reports. Advantages for the acquirers. The rights and benefits of the acquirers are not limited to the following points. The acquirers are exempt from consolidating the financial statements of the DCI. The acquirers are not required to make provision for the capital contributed to the DCI and can exclude the DCI when calculating regulatory ratios designed to limit how much a bank will invest in other enterprises. and subsidiaries. The acquirers can enjoy a higher credit quota granted by the SPV. The acquirers have the right to sell, transfer, merge, or continue to maintain the DCIs and subsidiaries after completing the restructuring plan. The acquirers could be able to lift their FOLs up to 49%, according to the draft's amendment and supplement to Decree number 1, 2014 NDCP on foreign investors' purchase of shares of Vietnamese credit institutions. However, we note that VCB is an SOE bank. According to decisions number 986 QDTTG on approving the development strategy of the Vietnamese banking sector by 2025 with a vision to 2030, SOE banks must ensure the state's ownership at 51% in 2021 to 2025. Challenges for the acquirers. Apart from advantages, we believe that the acquirers will also face challenges and pressure to restructure the DCIs. This will take time, effort, human resources, as well as technological resources from the acquirers to help and support the DCIs. The acquirers currently expect that it will take around 8 to 10 years to restore normal operations to the DCIs, overcome weaknesses, and become a bank with a healthy financial status. However, it could take the acquirers a longer to finish their restructuring plans, which would increase their cost. Corporate bond issues. Some of the content of this section was discussed in our banking sector update report that was published on the 7th December 2022. In this report, we include further discussion of recent government actions related to these issues. Exposure of books to corporate bonds and the real estate sector. Several developments in 2022 could create pressure on the ability of corporate bond issuers to refinance. According to the Ministry of Finance, around 53% of corporate bonds outstanding in June 2022 will mature within the next 2 years, in which real estate corporate bonds accounted for 35.9%. These events in 2022 include 1. Arrests of chairpersons of some big real estate developers, Tân Hoàng Minh and Phan Thịnh Phát, on charge related to corporate bond issuance, which created negative sentiment among corporate bonds investors. Decree 65 promulgated by the government in September 2022 regarding corporate bond issuance tightened the requirements for both issuers and investors. Please refer to our report. Corporate bond regulation update highlights on Decree 65 for the key changes in this new regulation. 3. Moreover, the SPV raised rates by 200 basis points in September to October 2022, and the credit quotas for banks have been under tight control by the SPV. If issuers, especially real estate developers, are unable to refinance, this could negatively impact earnings of the banks as it could trigger higher NPL formation and provisioning expenses. However, we estimate that as of June 2022, corporate bonds held by banks accounted for only 2.7% of the total system-wide credit balance, in which corporate bonds issued by the real estate sector account for 49.8%, 1.36% of total system-wide credit. If we include the corporate bonds with corporate loans to the real estate sector, total exposure is estimated to account for around 6.8% of total system-wide credit. We conclude that the corporate bond portion in the system-wide credit balance is relatively small, and direct exposure to corporate bonds and the real estate sector is skewed towards specific banks. For banks under our coverage, we observe that for bank TCB, MBB, VPB, and TPB have relatively high exposure to corporate bonds and the real estate sector. Banks' exposure to real estate sector as of June 2022. Government supports. Since the crackdown of the corporate bond market in April to November 2022, there were no official statements from the government regarding specific intervention in the corporate bond market. During this period, we believe the government, one, ensured that the banking system remained liquid, and two, encourage real estate companies to plan ahead to secure funding sources to fulfill their financial obligations and improve cash positions. We observe several companies do this by offering discounts to pre-sales or even liquidate some assets. Starting in December 2022, we believe we have observed the following new developments in the government's approach to corporate bonds and the real estate markets. First, on the 9th December 2022, the MOF proposed to amend and supplement Decree 65, which aims to support bond demand and avoids potential serial defaults in the bond markets. The key proposals include a one-year delay in the requirement of individual investors to be qualified as a professional individual investors to participate in corporate bond private placements. We believe this change allows more individual investors to buy corporate bonds through private placement, which facilitates the demand side. However, the MOF emphasized that the media should publicize the corporate bonds risks that retail investors could face. A one-year delay in the implementation of one, the requirement that specialized issuers must have a credit rating, and two, shortening of the bond distribution period of 90 days to 30 days. Our interpretations are that point, one, loosens requirements in the corporate bond issuance process for specified issuers in the short term as having a credit rating is time consuming and increases insurance cost. Meanwhile, point two allows issuers to have more time to distribute bonds. Therefore, they could increase the distribution to retail investors. Corporate bonds issued before the promulgation of Decree 65 can extend their maturity by a maximum 2 years, subject to the approval of bondholders that represent at least 65% of outstanding bonds. This would have to spread out the amount of bonds coming due to 2025, 2026, instead of it being concentrated in 2023 to 2024 following expectation that the continual growth of Vietnam's economy would have to resolve liquidity issues and bond obligations by 2026, allowing due payments, principal and interest of corporate bonds to be converted to loans or other assets, subject to negotiation between issuers and investors in addition to being in compliance with relevant laws. We believe this would allow issuers to be more flexible in restructuring their bonds. Second, on the 14th December 2022, the Prime Minister requested the SPV to lend and disburse funds quickly to eligible developers and real estate projects that comply with applicable regulations. An emphasis was put on the prioritizations of one, property developers with solid track records and real estate projects with good legal statuses, as well as two, home buyers with real demand who can still approach bank loans. This should have to improve the liquidity issues in the real estate markets. We believe the above support could be sufficient to prevent difficulties at specific companies from escalating into a systemic problem for the banking system and the broader economy. Conclusions on real estate and bonds. We believe the current structural position of the economy and the banking sector is much stronger compared to the period of downturn 10 years ago as one. Credit growth and inflation have been kept under control in recent years too, because banks have a healthier balance sheets with stronger capital ratios and provisioning buffers. According to the Vietnam Bond Market Association, the value of bonds bought uh, bought back before maturity in 11 months 2022 was 164 trillion Vietnam dong, which increased 32% over the same period in 2021 and accounted for 12.6% of total outstanding bonds in June 2022. This shows the initiative of companies in fulfilling their financial obligations, which should restore confidence in the market and also reduce the burden of bonds maturing in 2023 to 2024 forwards. In addition, we believe that not all corporate bond issuers will face difficulties in refinancing their obligations. Also, although it's likely that there will be greater scrutiny of issuers by banks and investors, and higher risk issuers may have to pay higher spreads in order to refinance. The four banks under our coverage with high exposure to corporate bonds and real estate, MBB, TCB, TPB, and VPB, have relatively strong capital ratios. TCB, VPB, and TPB and are relatively strong provisioning buffers. MBB, TCB, and TPB that would have to absorb pressure from higher credit cost. CAR of banks under our coverage Q2 2022 and Q3 2022. NPL ratio, annualized write-offs over gross loans, and LLR of banks under coverage 9 months 2022. And that brings me to the end of my presentation about banks. Uncertainties remain, but valuations are attractive. So if you want to open a legal trading account, don't hesitate to contact with us with the information on the screen so that we can support you. Like, subscribe, and follow our channels to receive more helpful information. So thank you for your listening and see you next time.